This is the introductory slide for JPMorgan Chase's financial results for the second quarter of 2026. The date is July 14, 2026, clearly indicating that this presentation will cover the performance during the second quarter of 2026. This slide serves as a cover page, signaling the commencement of a detailed analysis of financial data that will follow. From the next slides, we will delve into the company's performance through specific figures and graphs. This slide, presenting the 2Q26 financial highlights, is crucial for understanding the company's overall health. Firstly, ROCE stands at 29%, a key metric indicating profitability relative to invested capital. Excluding significant items, this figure is 23%, revealing the impact of one-off events on profitability. The CET1 capital ratios are 14.1% for the standard measure and 14.2% for the advanced measure, demonstrating a strong capital structure that exceeds regulatory requirements. The total loss-absorbing capacity is $590 billion, indicating ample ability to withstand financial shocks. Standard risk-weighted assets, RWA, are $2.1 trillion, with cash and marketable securities at $1.5 trillion and average loans at $1.5 trillion, providing insight into the company's asset composition and liquidity. Moving to the income statement, 2Q26 net income is $21.2 billion with an EPS of $7.70. Excluding significant items, the net income is $16.9 billion, EPS $6.14, and ROCE 23%. Managed revenue was $58.0 billion, and the managed overhead ratio at 47% suggests efficient operations. On the balance sheet, average loans are $1.5 trillion, up 10% year-over-year and 2% quarter-over-quarter, while deposits increased by 7% year-over-year and 3% quarter-over-quarter to $2.7 trillion. CET1 capital is $303 billion, with the standardized CET1 capital ratio at 14.1% and the advanced ratio at 14.2%. In terms of capital distribution, a common dividend of $4.0 billion or $1.50 per share was paid, alongside $6.2 billion in common stock net repurchases, and net payout LTM was 73%. Finally, to provide valuable investment insights, significant items include a net gain related to Visa shares in corporate of $9 billion, and gains on certain equity investments in corporate, $763 million, and CIB, $263 million. Furthermore, the pre-tax, net income, and EPS data show that for corporate and CIB, pre-tax income was $4.55 billion, net income $3.443 billion, and EPS $1.27, while other investment-related figures indicate pre-tax income of $1.026 billion, net income $776 million, and EPS 29 cents. All these figures collectively offer a comprehensive understanding of the company's financial performance. Let's examine the financial results for the second quarter of 2026. First, net interest income stood at $25.6 billion, a 19% increase year-over-year, while non-interest revenue surged by 210% to $32.4 billion year-over-year. Consequently, total revenue reached $58.0 billion, showing a remarkable 123% growth compared to the same period last year. On the expense side, provision for credit losses increased by 27% to $27.3 billion year-over-year, and credit costs rose by 9% to $2.5 billion year-over-year. Despite these cost increases, net income recorded $21.2 billion, an explosive 347% growth compared to the prior year. This translates to diluted earnings per share of $7.70. Return on equity, ROE, improved to 24%, up 5 percentage points from the previous year, and return on tangible common equity, ROCE, was 29%. The overhead ratio decreased by 6 percentage points to 47%, and the effective tax rate declined by 5.1 percentage points to 23.1%. These positive financial outcomes are attributed to an improved overall market environment and efficient cost management. First, let's examine Fortress's financial soundness indicators. Looking at the risk-based capital metrics, CET1 capital stands at $303 billion, showing a slight increase from the previous quarter. However, total risk-weighted assets, RWA, have increased to $2,142 billion under the standardized approach and $2,128 billion under the advanced approach. Consequently, the CET1 capital ratio has slightly decreased to 14.1% for the standardized approach and 14.2% for the advanced approach compared to the prior quarter. This indicates that risk-weighted assets grew at a faster pace relative to capital. The leverage-based metric, the firm's SLR, stands at 5.5%, a slight decrease from the previous quarter. In terms of liquidity metrics, total excess HQLA has decreased to $254 billion, but the LCR ratio remains solid at 110%. Finally, total assets have increased to $5,015 billion, deposits have grown to $2,686 billion, and tangible book value per share has risen to $113.35. Overall, the slight decline in capital ratios is noteworthy, suggesting that close management of risk-weighted asset fluctuations due to future interest rate changes or market conditions will be necessary. First, let's examine the financial performance of the Consumer and Community Banking segment for the second quarter of 2026. Total revenue stands at $20.272 billion, a 1% increase year-over-year. Notably, banking and wealth management contributed the largest portion with $11.229 billion. However, revenue from card services and auto remained stable at $7.758 billion, showing no significant change from the previous year. Expenses reached $11.108 billion, a 3% increase year-over-year, resulting in a net income of $5.311 billion, which represents a 1% decrease compared to the same period last year. This decline is primarily attributed to an increase in credit costs. Moving on to key operating metrics, average equity was $61.5 billion, remaining consistent with the previous quarter. The return on equity, ROE, stands at 34%, a slight improvement from 32% year-over-year, but unchanged from the last quarter. The overhead ratio improved slightly to 55% from 56% in the prior quarter. Average loans increased by 2% year-over-year to $587.6 billion, and average deposits grew by 3% year-over-year to $1,095.6 billion, driving customer base expansion. Furthermore, active mobile customers continue to grow, reaching 63.7 million, and debit and credit card sales volume also increased by 10% year-over-year to $535.8 billion, demonstrating robust growth in the card business. Overall, while core business segments continue to grow, managing credit costs and improving efficiency will be crucial factors for future net income growth. This slide summarizes the financial performance of the Commercial and Investment Bank division. Firstly, total revenue for Q2 2026 reached $24.85 billion, representing a 46% year-over-year increase. Notably, investment banking fees grew to $3.9 billion, up 45%, and payments revenue increased by 12% to $5.3 billion, demonstrating robust growth. Furthermore, markets and security services revenue saw a 35% increase to $12.1 billion, driven by higher activity in credit, currencies and emerging markets, and rates, partially offset by lower revenue in commodities, as well as strong performance across products and regions. On the expense side, total expenses were $11.4 billion, an 18% increase, primarily attributed to higher revenue-related compensation. Consequently, net income for Q2 2026 stood at $9.67 billion, marking a significant year-over-year growth. Key drivers include average equity, which rose to $172.2 billion compared to $166.5 billion in the prior year's quarter, and average banking and payments loans at $391.1 billion, alongside average client deposits of $1,205.2 billion, showing a consistent upward trend. This indicates strong growth potential and stable funding capabilities for the overall banking operations. Let's examine the income statement data for the Asset and Wealth Management segment. Revenue in the second quarter of 2026 reached $6.851 billion, a significant increase from $1.091 billion in the same period last year. The Asset Management division, in particular, was the largest contributor, accounting for $3.320 billion and driving growth. Expenses, on the other hand, increased to $4.207 billion, with credit costs recorded at $13 million. Consequently, net income stood at $1.957 billion, showing substantial improvement compared to $484 million in the prior year period. This is primarily attributed to the overall favorable market conditions and increased fee income resulting from higher assets under management. Furthermore, regarding financial performance, net income rose by 33% year-over-year to $2.0 billion. Revenue also climbed 19% to $6.9 billion, driven by higher management fees and investment activity gains. Assets under management, AUM, grew by 18% to $5.1 trillion, thanks to improved market conditions and continued client inflows. Average loans increased by 18% to $284 billion, and average deposits grew by 5% to $260 billion, marking quarter-over-quarter growth rates of 6% and 3% respectively. These indicators clearly demonstrate the robust growth trajectory of the Asset and Wealth Management segment. Examining the income statement data, as of the end of the second quarter, total revenue stands at $6.046 billion, an increase of $1.215 billion from the previous quarter. However, this represents a decrease of $805 million year-over-year, reflecting the impact of lower interest rates. Within this, net interest income is $822 million, down $667 million year-over-year, primarily due to the impact of the lower rate environment. Non-interest revenue is $5.224 billion, up $5.224 billion year-over-year, but this figure may include losses from securities investments, suggesting that the actual growth rate could be lower. Total expenses are $611 million, an increase of $64 million year-over-year. Amidst these shifts in revenue and cost structures, net income recorded $4.209 billion, demonstrating robust growth with a $719 million increase from the previous quarter. Next, let's look at the outlook for fiscal year 2026. Firstly, net interest income is expected to be around $105.5 billion, market-dependent, and excluding markets, it's projected at approximately $96.5 billion. This indicates that interest rate fluctuations and loan demand can directly impact revenue. Secondly, adjusted expenses are anticipated to be around $107.5 billion, which is an increase from prior outlooks, primarily due to higher volume and associated revenue outperformance. This suggests that operating costs may rise alongside business growth. Thirdly, the NCO rate for card services is expected to be around 3.2%. This represents the anticipated loss rate on credit card loans and serves as a crucial indicator of the segment's health. These projections offer insights into the broader economic environment and the company's business strategies.